Hello, welcome back, guys. So many days, if not pretty much every day, we're discussing in our Discord channel, for which you can find a link in the description box below if you want to join us, about all sorts of different stocks. And today, before the market opened, we were talking about Dick's Sporting Goods, and we kind of analyzed the company to the core. I mean, we tried to get as much information as possible about it, and things were looking nice. Now, after doing a little bit of a deep down, we discovered something that was a little bit worrying here. And I'm going to take you through the case and how you can actually analyze this and see the potential pitfalls that can actually warn you for a potential stock that may not be as good of a purchase as it initially looks like. And so let's go and start with Dick's here. It's obviously a very well-known retailer here. And it's selling like sporting apparel and things of that sort. I believe shoes and stuff of that kind. But if you take a look at the financials here, you will see that the P ratio and price to free cash flow ratio is exceptionally low. Both of these are exceptionally low. 5.8 here, 4.6, and they are going down. So this is already a great sign, and it's almost 50% down. If we take a look at the 5-year chart, you will see that it has been going great for the company for many years. But right now, it's on a little bit of a downtrend, as with the rest of the market, pretty much. And so this initially here you are noticing all these green marks, green check marks here. You're also noticing a massive amount of bought back shares here, outstanding shares getting bought. It used to be more than 100 million here. And what's interesting to see is that the total liabilities to free cash flow is about 5, is next to that, close to that. It means that it would take about 5 years of last year's free cash flow to pay back all the total liabilities that the company has. So all these things are looking great here. The revenue growth is not tremendous, but it's still pretty reasonable. And great net income growth, great free cash flow growth as well, and pretty okay total equity growth overall, almost the same. But you will also notice here that the margins of the company are respectable, are sitting at 12% right now, pretty much. A return on equity of 57%. And a little bit of extra debt than what we would like when you compare it to the equity of the company. And a dividend yield of 9% is what we're looking at here, but this is the last 12 months. And if we take a look at the dividends here, the dividends module, you will see that the effective dividend yield, the dividend yield right now is actually 2.5%. This is 9.1 in the last 12 months because of this special dividend here that was paid back in September. And so normally when you're buying this company, you're looking at 2.5 and a very great payout ratio here. So nothing to worry in terms of getting your dividends paid. Now we can also take a little bit of a look at the insider sales, and what I typically most like to see in terms of insider sales is purchases, because I want to see when people are actually purchasing stock with their own money. Because, people and employees and directors do sell a lot of stock, and it makes a ton of sense to sell stock because for many people it's actually part of their compensation, and so it makes a ton of sense. But when you are buying with your own money, that's an interesting thing to see, and this happened in June 2nd, 2022, pretty much, a few days ago, from a director here who bought about 404,000 in stock, in common stock here. And in terms of sales, if we really want to see that as well, you will see that there have been quite a few sales. But again, this can be normal, very normal, because people are actually spending their stock. They're actually liquidating their stock in order to make some money as part of their compensation, because many officers here, directors, executives are basically paid a large part of their compensation in stock. So that makes a ton of sense here. But you do see a lot of sales here, indicating you that there is a potential that the company is actually spending a lot in these kinds of awards, sort of, for people. Maybe they are kind of giving them quite a lot of stock here. So let's examine a few more details here about their company in terms of what they are doing. And I'll tell you what could potentially be wrong here. Now, when you are looking at the company as a whole here, you are looking at great stuff. Again, what we discussed here, metrics look great over here. And it looked interesting. It looked actually kind of cheap, practically speaking. And if you take a look at the income statement here, for example, you will see that the revenue growth of the company has been increasing pretty much, and net income has been increasing as well, pretty nicely, from 300 million to 1.5 billion here. And the balance sheet is also increasing slowly, but still, from 1.94 to 2.1 in terms of billions. And in terms of the total liabilities that the company has, it's about 6.7 billion, let's just say. And the cash flow that the company generates is about 1.4 last year. So it's about 5 years as we examine the free cash flow to pay back all the total liabilities. That's not too bad. Now, the problem arises from the company's from examining the company's outstanding shares and dilution, pretty much. And I actually took a look at it because I wanted to analyze the company a little bit more. It looked maybe a little bit too good to be true, actually. And so, if you take a look at our company analysis tab here, you can go to the SEC filings. And what I did is I examined the 10Q, the 10K. I kind of took a look at what the company has been doing quarterly and the annual statement here. And I have this opened up for you over here, and it's actually the 10Q. It's the latest quarter, as you'll see. And you can kind of see the financials here. And part of it actually tells you the amount of outstanding shares. You will see that there are 76 million over here. These values are in million. And you will see that the amount of outstanding shares in basic terms, they are the basic outstanding shares, are 76 million. But the diluted ones are 108 million. That's about 40% more. And that is extremely significant. You can see what kind of shares these are. These are like stock-based awards, convertible senior notes, and warrants. Now, the problem with these kinds of diluted actually stocks here, outstanding shares, is the fact that they can be exercised at multiple points in the future. And so you need to be taking this into account. And typically when you are looking at the PE, the PE doesn't actually take this into account. You need to take a look at the diluted PE. And this is a case here. Normally these are very close to each other. But in this case, they are actually quite significantly different. Like the basic EPS is 3.42 and the diluted one is 2.47. And so, just by looking at this, you kind of know that there may be a little bit of a potential time bomb here that could actually go off on you in the future, with many people actually exercising their warrants here, or stock-based awards, or senior notes. So, what we can do here is what we want to do is go back and take a look at our stock evaluation tool, but also bear in mind that we're potentially looking at a 40% increase of the actual value that we're getting here, because again, the original shares that the company, the outstanding shares that the company has, is actually 76 million. But if you add the outstanding shares, the diluted outstanding shares, then it gets to this weird case scenario. And this is something that I will potentially add to the tool. I will for sure add to the tool actually in the future as a warning, sort of, that will actually let you know that there is a big difference in terms of outstanding shares and diluted shares here. Now, we will still do our normal thing, and we will go with a revenue growth that is going to be fairly low here. Now, the company has been doing pretty well, but I do want to try much lower values here, like 6, 8, and 10. And the net income margins that I'm going to be using, again, the company has been doing much better, from like 3 to 5 to 12 here, but we're gonna go somewhere, I guess, in between. Let's just go 8, 10, and 12 and see what we get out of this. And the free cash flow margins that we're getting is about 80, maybe 90%. We're gonna go 80, 90, and 100, and 13% for our annual return. We hit calculate here, and you will see that our current price is sitting at 75, and with this kind of revenue growth and net income margins and free cash flow margins, which are very, very possible to happen, we are sitting at a low of 177, super cheap here, as you can see, extremely cheap. And the only thing that you would need to actually do here is basically add this 40% on top of that. So what I would basically do here, for example, is kind of consider that this low price is actually like 40% higher than what I would want it to be. So I can extract like 40% of it and be somewhere close to 120, for example, or 110. And in this case, we are still in the green. Now, it is concerning that the company has this sort of like trickiness to it, yet they are so cheap right now that it could still be an interesting buy, actually. And I have some concerns about these kinds of companies because, you know, they are retailers coming out of COVID, although Dix actually did very well during COVID, or I guess as we are exiting COVID too. And it's a potential company that it may be worth adding to a portfolio at least a little bit. But as I always mention, you don't really want to overdo it with retailers at the current environment. I would maybe have one or two that are the best, but then again, not overdo it with all the retailers really and get too many in my portfolio. This one is fair, but I did want to tell you a few things about what. And so I hope the video was useful to you. Remember to leave a like and subscribe. And as usual, you can of course become a patron and get access to this tool. You can find links in the description box below this video. Thanks for watching again, and I'll see you in the next one, guys. Bye bye.